Day trading options. You can be right on direction and still lose money. Here's why.
Here's the trap most retail traders fall into the first week they trade options. They've day traded stocks, they know how to read a chart. They buy a call, the stock moves up, and the call still loses money. Because in stock day trading, one variable moves, price. In options, three variables move at once, price, time, and implied volatility. Until you understand how those three interact inside a single session, you're flying blind, and the market knows it. Let me show you the mechanism. When you buy a stock, your P&L is linear. Stock up $1, you make $1. When you buy an option, three forces hit the price simultaneously. Delta tracks the underlying. Theta, time decay, bleeds the option's value every minute, accelerating toward expiry. And vega, implied volatility, can collapse independently of price, especially after a catalyst like earnings. A long call buyer can be right on direction and still lose money because IV crushes faster than the stock moves. That's not a bug, that's the math. And near expiry, gamma turns large, meaning your delta itself accelerates with each move, and the position behaves non-linearly. So a directional view alone isn't a strategy, it's a guess. Now the 5 workhorses. Long calls and puts, pure directional debit plays. Cheap entry, theta and vega working against you, profit potentially unlimited. Best when you expect a fast, definitive move. Vertical debit spreads. Buy one option, sell a less favorable strike in the same expiry. You cap your profit, but you also cap your loss. Slash your vega exposure and pay less premium up front. Vertical credit spreads. Sell one option, buy further out of the money. You collect premium up front. Time decay now works for you. You profit if the underlying stays on the right side of your short strike. Defined max loss equals strike width minus credit. Then iron-condors. Sell an out-of-the-money put spread and a call spread on the same expiry. You profit if the underlying stays inside a range. This is the quiet day strategy. And finally, long straddles and strangles. Buy a call and a put on the same name, betting on a big move in either direction. Heavy theta cost. Useful around scheduled events, rarely a daily bread and butter trade. Now here's the single filter that separates working traders from losing ones. Implied volatility relative to its recent range. When IV is high, selling premium has positive expectancy. You're getting paid to wait. When IV is low, buying premium gets cheaper because the market isn't pricing in much movement. A trader who only buys long calls will lose money during high IV periods even with the right direction. A trader who only sells iron-condors will lose money during low IV trending markets. One strategy for all regimes doesn't work. Compute the current IV percentile rank, where current IV sits relative to its 1-year history. Above 50%, lean toward selling. Below, lean toward buying. That single filter outperforms most chart-based systems. Okay, the IV side matters. The cost side matters more. Let's pull it apart. Same day expirations, 0 days to expiration, zero-dte, are now available daily on SPX, SPY, and QQQ. The mechanics are extreme. Gamma is enormous near the money. A $1 move in SPY can change a near the money options delta by 50% or more in the final hours. Theta drops in measurable chunks every minute after lunch, and bid-ask spreads widen near close, making your exit harder than your entry. Naked zero-dte shorts have wiped out individual retail accounts on a single afternoon move. Hundreds of thousands of dollars gone in an afternoon. For retail, the only acceptable zero-dte structures are defined risk, condors, debit spreads, short verticals. Anything else is a slot machine. Now the rule that catches every US trader off guard. FINRA's pattern day trader rule. Make 4 or more day trades in 5 business days inside a margin account and you're flagged. Once flagged, you need $25,000 of account equity at the start of every day. Drop below it, your account is restricted to closing trades only until you top it back up. Cash accounts are exempt, but you hit T+1 or T+2 settlement, which kills round-tripping the same dollars intraday. Offshore brokers fall outside the rule, but you lose US regulator protection and FINRA arbitration. The arbitrage rarely works in your favor. And 25,000 is a floor, not a target, because no single intraday position should risk more than 1 to 2% of account equity. On a $25,000 account, that's $250 to $500 of defined max loss per trade. Realistic position sizes are small, 1 or 2 condors, a handful of long calls, not the screen of contracts you see in trading influencer screenshots. And costs bite harder than people expect. 20 round-turn contracts a day on liquid SPY, Commissions and exchange fees might run $25 to $50, but the bid-ask spread, another $40 to $80 before any market view shows up. Commission is one component. The hidden cost is the spread, which is why a broker with tight quotes and a working smart order router matters more than chasing the absolute lowest commission. Multi-leg order entry. Entering a vertical or condor as one ticket is non-negotiable. So is access to live Greeks on the option chain. If you're entering each leg separately, you're paying slippage twice. So what actually separates the traders who survive from the ones who blow up? 5 rules, non-negotiable. 1. Size against defined max loss, not premium paid. Buying 5 calls at $50 each isn't a $250 position. It's whatever the actual delta adjusted exposure tells you. 2. Predefine exits before entry. Profit target and stop written down. 3. Avoid naked short options. Selling naked OTM calls and puts has an 80% win rate, and the 20% losses are 10 times larger than the wins. The math doesn't work long term. 4. Be careful with assignment on short ITM equity options. Close before expiry, or use cash-settled index options like SPX or NDX. 5. No revenge trades. Daily loss limit, hit it, stop. The fastest way to turn a $300 loss into a $3,000 loss is doubling down to make it back. And here's the part that ties it together. The one Greek retail traders consistently underrate: vega. Long options are long vega. Short options are short vega. After an earnings release, IV can collapse from 80% to 40% in minutes. The stock moves the right way. Your call still loses money. That's not the trade going wrong. That's you not separating the directional view from the volatility view. Earnings trades are almost always volatility trades disguised as directional trades. Read them that way. So who is options day trading actually for? Honest answer, traders with at least $25,000 of risk capital, a daily routine, a written journal, and the discipline to follow defined risk structures. If you're underfunded, underprepared, or you can't write down a stop level before you enter, options will find you out faster than equities ever did. The reason the math is hard isn't the Greeks. It's that 3 variables move at once, and most retail strategies only account for 1. Get the IV regime right. Use defined risk structures, verticals, condors, debit spreads. Size against max loss. Avoid naked shorts. Close ITM equity options before expiry. And track every trade in a journal. That journal will teach you more than any course will. The traders who survive aren't the ones with the best strategies. They're the ones who follow the same 5 rules on a Tuesday afternoon in August that they followed on the day they opened the account.
3 variables, 5 rules, 1 journal. Follow them every session. Full breakdown linked in the description.